All right, great. So welcome to tonight's presentation, Understanding College Financial Aid and Paying for College. We're going to go through quite a bit of material tonight. I hope that it will be clear and helpful for everyone. I like to start with a few of the fundamentals that are really important to keep in mind as you're thinking about college financial aid, and we'll touch on all of them in more detail as we go along. So one of them is to always remember that what really matters when you're thinking about financial aid is gift aid, grants or scholarships. That's free money that you do not have to pay back. Almost all gift aid comes directly from colleges. So a lot of people think that they can apply for scholarships and help pay for the cost of college that way. And it certainly is good to try to do that. But for the vast majority of people, the big piece of financial aid comes directly from colleges. So choosing which colleges to apply to has a much bigger impact on your final cost than almost anything else. Another important point is that the true cost of college is called the net price, and that's the college's starting cost minus any gift aid that you might receive. How much gift aid your student gets depends on your student's profile in terms of eligibility for need-based aid and potentially academic scholarships based on things like their grades and academic background, and crucially, how colleges award their aid. So if you have a lot of financial need, but you're applying to colleges that don't meet financial need, you're probably not going to get a lot of aid. If you don't have a lot of need and you want to find colleges that will be a little bit less than their starting costs, then you need to look for colleges that use merit aid. And we'll talk about both of those points in a lot more detail. Another important point, unless you apply to affordable colleges during the fall application season, then having affordable choices when your student is ready to decide where to go to college is going to be a matter of luck. And affordability means something different to everyone. It's based on your student's net price and the resources that you have available to pay for college. So we will talk about that all in more detail this evening. So the agenda is assessing where you might get aid and deciding what you can afford. Assessing where you might get aid is a matter of defining your student's profile in terms of potential eligibility for need-based aid and or academic scholarships, and matching that to the way colleges award aid. Deciding what you can afford is a question of making sure that you understand the true total cost of college. That's the net price of a degree. Understanding the resources that you have to pay the cost, and the biggest resources are going to be either savings or money from income that you can use during the college years to pay for college. If savings and income is not enough, then you may have to think about borrowing to pay the cost of college. And in that case, it's crucial that you think about whether the amount that you're thinking about borrowing is reasonable and appropriate. So we'll talk about all of these things this evening. So when people talk about the cost of college, they tend to think about the sticker price, which at USM and Orono is $23,000 to $26,000. At University of New England, it's about $57,000. And at Bowdoin, it's $74,000 for 1 year of college. However, it turns out that colleges award gift aid in significant amounts, and that has a tendency to reduce the cost of college. So the average net price for students who receive gift aid is about $12,000 at USM. It's about $16,000 at Orono, $36,000 at UNE, and $25,000 at Bowdoin. But there's another piece of the story too, which is that not every student receives gift aid. So at USM, about 88% of students receive gift aid. At UNE, 100% of students do. And at Bowdoin, 52% of students do. What that means is that at Bowdoin, 48% of the students at Bowdoin are paying that full $74,000 a year cost. So when you factor in the students who don't receive aid, the true net price for all students ranges from about $12,000 at USM, $16,000 at Orono, $36,000 at UNE, and about $49,000 at Bowdoin. So as you can see, all of these numbers can be kind of confusing, and it's important that you focus in on the real important ones, and that you not get distracted by clickbait, which says, you know, here are the most affordable colleges. Well, that's usually telling only part of the story. And what really matters is not what colleges charge or what you'll see in these internet stories. What matters is what you are going to pay. And what you're going to pay is your student's individual net price, which is equal to the college's starting cost, or COA, that stands for cost of attendance, minus any gift aid that your student might receive. So there are two main categories of financial aid. One of them is gift aid. That's money that is going to reduce the cost of college. It's free financial aid that you do not need to repay. That's typically called grants if it's referring to need-based aid, or scholarships is a common term if it's referring to merit-based aid based on the student's academic background. The other type of financial aid is self-help. And this is important for a lot of people, but it doesn't reduce the cost of college. It only helps you to manage the cost. So self-help includes work study. This is a job that a student gets during the college year that he or she can use to help pay for college expenses. And loans, money that you borrow to pay the cost of college, but then you have to repay after college with interest. Well, when you put it this way, most people are pretty clear that gift aid is a lot better than self-help. But colleges don't always make it easy to distinguish them. And here's what I mean. When colleges tell you how much financial aid your student is going to get, they typically do it on what's called an award letter. And this is a typical award letter. And if you add up all of the lines of financial aid, it looks like there's about $22,000 of aid. Well, that's a lot of money. That's great. But when you look into it in more detail, it turns out that only 4 of the line items are gift aid, 2 of the lines are loans, and 1 of them is work study. So when you subtotal those to see the amount of gift aid and compare it to loans and work study, it turns out that there's about $15,000 in gift aid, about $5,500 in loans, and $1,800 in work study. Well, $15,000 is still a lot of money, but it's not nearly as good as $22,000. And there's still some important information missing, including the starting cost and your true cost, the net price after aid. So I went online at this particular college and I looked it up, and it turns out that the starting cost was about $50,000. When you subtract $15,000 in gift aid, the true net price for 1 year at this college was about $34,865. So keep this number in mind. We're going to come back to it at the end of the presentation. But for now, let's go into a little bit more detail about the different types of gift aid. So we said that there are two main types of gift aid. One of them is need-based aid, which is typically called grants. This is going to be based on the income and assets of the students and the parents. You apply for need-based aid at all U.S. colleges using the FAFSA form. The FAFSA is required at all U.S. colleges for loans as well. In addition to the FAFSA, about 150 colleges require a second financial aid application called the CSS profile. And these 150 colleges use the CSS profile to allocate gift aid that they fund themselves. So the FAFSA is typically used for state and federal gift aid. The CSS profile is often used for college-funded gift aid. The other type of gift aid is scholarships, which is often based on the academic track record of the student. And the things that colleges typically look at when they're thinking about merit aid are grades, test scores, class rank, and so on. Now, this is often awarded automatically. So when the college sends your student a letter saying, congratulations, you've been admitted, we'd like you to come, they'll often also say, and we're going to award you X number of dollars in scholarships. However, sometimes scholarships may require additional applications to get them. So you always want to check on a college's financial aid website to understand exactly what you need to do and what the timeline, what the deadlines are to make sure that you will qualify for as much aid as possible. So let's go into the grant portion. That's need-based aid. And this is what people typically think of when they talk about financial aid. So this is the first thing that usually comes to mind when people say, how am I going to qualify for financial aid? Well, need in the financial aid world has a very specific definition, and that's COA minus EFC. I'll explain that in a minute. But what you need to remember is that need is your potential eligibility for aid. It's not the amount that you're actually going to receive. It's the maximum amount of need-based aid that you might receive. COA stands for cost of attendance, and that's always made up of 4 elements: tuition and fees, room and board, books and supplies, and then transportation and other miscellaneous expenses. EFC stands for expected family contribution. And this is one of the most misleading terms in the English language, because if you read the words, it makes you think that that's what you're going to pay for college. But in reality, very few people pay their EFC. Sometimes you pay more, sometimes less, but that's usually not the actual number that people pay for college. The EFC, though, is important because the lower the EFC, then the greater the need, meaning the greater the potential eligibility for aid. So all of the things being equal, a lower EFC means you might get more need-based aid than a higher EFC. Another important point is that college aid awarding policies vary. So some colleges award full need-based aid based on the FAFSA or the CSS profile EFC. Other colleges meet some or no need with gift aid. So the way the college awards its aid is going to have a big impact on your true cost of college. If you want to estimate your EFC, you can go to this website. It's run by the College Board, and it will allow you to estimate your EFC based on the FAFSA and the profile. Now, knowing your EFC is helpful, but it's not sufficient. So what do I mean by that? Let's say that you go to that website and you find out that your EFC is 35,000. What that means is that you're not going to qualify for any need-based aid at the University of Maine, because the University of Maine's starting cost at 26,000 is less than the EFC. That means there's no need, no eligibility eligibility for aid. On the other hand, at Bowdoin, their starting cost is about $75,000. So if your EFC is 35, you might qualify for as much as $40,000 in need-based aid at a college like Bowdoin. Another important point is that each college defines its own idea of need. And the college's idea of need is rarely the same as the family's, but obviously the colleges are the ones who are going to determine what that true aid award is going to be. So we said that EFC determines eligibility for need-based aid. A lower EFC in general means more eligibility for need-based aid. There are two EFC formulas, one based on the FAFSA and one based on the CSS profile, but they both have the same basic approach, which is to look at the income and the assets of the parents and the student. So when that EFC is calculated, there are actually four subtotals going on in the background, four calculations going on in the background that when all added together equal the student's EFC. A couple of things to keep in mind when you're thinking about the EFC. The portion from income is going to be based on two types of income. One is adjusted gross income, that's from your tax return. And then colleges will add certain items of untaxed income, income that doesn't go on your tax return or that isn't subject to income taxes, but which colleges think is part of the resources that could be available for college. Income for most families plays a much bigger role in determining the EFC than assets. So it turns out that once you reach a minimal level of income, every dollar of additional income is going to add about 47 cents to the EFC. When you reach that minimal level of assets, every additional dollar of assets is going to add about a nickel to the EFC. So income in general adds about 10 times more than assets do to the overall EFC calculation. And so it's much more important in most families' financial aid picture than assets are. When colleges look at student income and assets, they calculate the portion of the EFC similarly. Most high school students don't have a significant amount of impact that's high enough to really impact the EFC, but sometimes students do have some assets. And if a student has assets in his or her name, those do have a greater impact on the EFC than they would if they were in the parent's name. So if a student happens to have $10,000 in savings, that could add $2,000 to $2,500 to the EFC. If that $10,000 were in the parent's name, it would add only about $500 to the EFC. It turns out that there is a loophole, and unlike most loopholes, this one is available to regular people. And that is that if a student has assets and you put those assets into a student-owned 529 account, the financial aid rules will treat that as if it were a parent asset. So if you happen to have a student who has significant savings and you might qualify for need-based aid, that's potentially a way to qualify for a little bit more. Now, when the EFC is calculated, there are some special cases that are worth talking about. One of them is when multiple siblings are in college. In this case, if the siblings overlap, if they're in college at the same time, the parent portion of the EFC is shared among those siblings. And that can have a significant impact in lowering the EFC for each student. Now, there's going to be a major change in the way the EFC is calculated, and that's going to be coming up in about 2 years. I'll discuss that later, but one of the important elements is that for the FAFSA, that sharing of the parent contribution among those multiple siblings will be going away. That will no longer be in effect. So that could have an impact on some people's planning. Another special case is the case of a family whose financial circumstances have changed. So when you fill out the FAFSA and the CSS profile, they're going to be asking you about income that was earned in the past. And in some cases, there might have been changes, perhaps a loss of a job, maybe a change in family circumstances. And in those cases, colleges have the ability to adjust the EFC and potentially make you eligible for more need-based aid. What you want to do in that case is to fill out the FAFSA and the CSS profile using the information that they ask for. But if your income has changed, for example, you want to let the college know that your financial circumstances have changed and that you would like to be considered for professional judgment to increase the amount of aid eligibility. Colleges have the ability to do those evaluations and potentially make you eligible for more aid. They don't have the obligation, and the college's determination on that will be the final decision. The final special case that we want to talk about is when parents are divorced or separated. And here, the FAFSA and the profile have very different approaches. The FAFSA considers the custodial parent only, and if that parent has remarried, they will also look at the income and assets of the new spouse. So if a student's parents have divorced, and let's say the student lives with the dad, they'll be looking at the dad's income and assets, but not the mom's. If the dad has remarried, they will also be looking at the new parents' income and assets as well. The profile is going to look at both biological parents, regardless of whether they're living together or divorced. And if those biological parents have remarried, they will also look at the new spouses. So the profile may be looking at the income and assets of as many as 4 different people when it determines eligibility for need-based aid. Now, the profile does try to do some calculations that will put the primary burden on the biological parents, but those calculations are imperfect. So it can be disadvantageous if biological parents have remarried during the college financial aid years. So we said that the FAFSA and the profile are going to be asking about income that was earned in the past. And here's an example of how that timing works. This is for a student who's a current senior in high school, going to graduate with the class of 2022 and enter college in the fall of 2022. The FAFSA and the profile are going to be looking at income that was earned during the calendar year that ended December 31st, 2020. So that's the year that ended this past December. In April, you filed your taxes for that year. Now your student is getting ready to apply to colleges, and beginning October 1st, both the FAFSA and the CSS profile have been available to fill out as your student is applying to colleges. What that does is it means that when your student is admitted, the colleges will be in a position to determine whether or not your student will qualify for need-based aid. So that's the timing for income on the FAFSA and profile. Assets are valued as of the filing date. So if your student is getting ready to apply to college, then you're going to be looking at the value of your assets as of approximately now. If your student is applying for November, you want to try to get the FAFSA and the profile done by late October or around the same time your student applies. This can potentially give you a another planning tip. So remember, more assets probably mean more EFC. So if you can report fewer assets, even though they don't have as much impact as income does, it can potentially be to your advantage. Now, obviously, you don't want to spend money foolishly just so that you don't have the assets. But if you have expenses that you know you need to make, it could be advantageous to make those payments before you file the financial aid forms. So an example of that might be someone who's self-employed and needs to pay quarterly estimated income tax payments. It could be to your advantage to make that quarterly income tax estimated payment before you file the FAFSA and the profile, so that the amount of assets that are considered for financial aid is a little bit less. Now, as I said, I'm going to make these slides available to everyone. So I've got a page for each year of high school. So for students in the class of 2022, for the first year of college, they're going to be looking at 2020 income. For the second year, 2021. The third year will be 2022, and the fourth year will be 2023. You need to file the FAFSA and the profile typically every year. The FAFSA definitely every year, and the profile, if it's required, usually every year as well. This potentially provides another planning tip. So the way the financial aid system works now, if a relative who's not a parent is planning to help pay for college, that payment is considered untaxed income to the student in the year in which it's received. So if a grandparent, for example, is going to help out, that amount of the payment is going to be considered income to the student and could potentially raise the EFC and thus make the student eligible for less need-based aid. If that could be a factor for your family, what you might want to do is have the grandparents make those payments after January 1st of the student's sophomore year. It turns out that the final year that's going to be considered for financial aid purposes is the calendar year that ends when your student is a sophomore in college. So if the grandparents make that payment after January 1st of sophomore year, the final income year being considered for the FAFSA and the profile will be over, and it will not have an impact on need-based aid. Now, that is another one of the things that's going to be changing in terms of the FAFSA. In 2024, the FAFSA will no longer consider grandparent payments as income to the student. However, I strongly suspect that the profile will continue to consider that income. So I think that planning tip will probably still be worth remembering, even with that change in the FAFSA. These are the dates that are going to apply for juniors, for students who are now in 10th grade in high school, and 9th graders. So if you request the slides, you can have these tables. Now, as I mentioned, the FAFSA is changing, and a really important question is whether the profile will as well. The changes, for the most part, are going to be effective in the academic year that begins in the fall of 2024. That means that the current high school class of 2022 will have 2 years using the existing FAFSA rules and 2 years using the new FAFSA rules. Most income items are going to come directly from the IRS. You may have heard that you can import IRS data into the FAFSA. And beginning in 2024, even more of that information should be directly importable from the IRS. In addition, they're going to change that term that I dislike so much. EFC, or expected family contribution, is going to become SAI, or student aid index. It's still going to be calculated and have the same impact in terms of calculating eligibility for need, but at least the term will not be as misleading. If the parents are divorced, then the custodial parent is going to change. So currently, the custodial parent is the parent with whom the student lives more than half of the time. Beginning in 2024, it's going to be the parent who contributes the greater portion of the student's financial cost. And then, as I mentioned, college payments from relatives will no longer count as student income for the FAFSA, but be careful because I think they still will for the profile. And then that discount for multiple siblings in college simultaneously will be eliminated for the FAFSA. What's going to be the impact of these changes? Well, very needy students are going to benefit. It's really going to be an advantage in most cases for students with high financial need. A crucial question is going to be what's going to happen to the CSS profile. Will the CSS profile make changes that conform to these new FAFSA changes? The reason that's so important is because the most generous need-based aid comes from profile colleges. And at those colleges, the maximum annual aid that you might get based on the FAFSA is perhaps $7,000 to $10,000 per year. But the maximum aid that you might get based on the profile could be as much as $70,000 a year. So the stakes are a lot higher in terms of what the CSS profile might do. If you're applying to colleges that don't use the profile and are relying only on the FAFSA, unfortunately, what often happens is that these colleges don't have the resources to meet full financial need. There's often a gap between the amount of need that's calculated based on the FAFSA and what the college is going to award in aid. So it's very important what the profile is going to do. And here are my educated guesses of how the profile is going to respond to some of these major FAFSA changes. I believe that the profile will conform to the FAFSA in the way the custodial parent is determined. So I think that it's likely that that's going to be based on which parent provides more of the student's financial support in just about all cases beginning in 2024. I think it's very unlikely that profile colleges will not count payments from grandparents or other relatives. So I think that there's going to be a distinction between the way the FAFSA and the profile treats those payments. And I think that the profile may or may not eliminate that multiple sibling and college discount. My hunch is that most profile colleges will continue to discount that, but that's up in the air, and colleges have not made any announcements about that as yet. So the bottom line is that there's a lot in flux. And if you're considering these FAFSA changes, and really, if you're thinking about financial aid in general, my advice is not to make major changes solely for the purpose of financial aid. If you're going to make changes to your financial profile, make sure that whatever changes you make sense from your overall financial planning standpoint, not just financial aid. All right, so what we've talked about so far is identifying the student's profile in terms of the student's potential eligibility for need-based aid. If your student has financial need, then what you want to do is to find colleges that might meet that need. So this is a website that shows some financial aid statistics. And what I want to zero in on is the percent of need met. So at the University of Maine, on average, about 73% of financial need is met with financial aid. That sounds good. That's about 3/4 of financial need. However, out of the need that's met, about 54% of it is met with gift aid, scholarships, and grants, and 46% of it is met with loans or work study. So remember, grants are a lot better than loans or work study. And the bottom line at the University of Maine is that on average, meeting 54% of need with meeting 73% of need and only meeting 54% of it with gift aid means that on average, about 39% of total need is met with gift aid. Now, the University of Maine is usually affordable for Maine students, but that's because it's got a lower starting cost for Maine residents, not because they have an especially generous need-based aid program. At NYU, they meet about 71% of need, and 77% of that is met with gift aid. So you multiply those together, and 55% of total need on average is met with gift aid. That's not a great number considering that NYU is about a $75,000 to $80,000 college. At BU, 93% of need is met and 80% of it is met with gift aid. So about 74% of need is met with gift aid on average. And at Colby, which is kind of the gold standard of having a generous need-based aid program, they meet 100% of need as they define it. And of that, 92% of it is met with gift aid. So they'll meet full need and most of that will be met with gift. Now, these are averages. So what they do is they give you an idea of where to look if you're trying to find colleges that might meet your financial need, but they don't tell you your true cost. And we'll talk about how you can get to your true cost in a few minutes. Another important point is even if you qualify for need-based aid, will the amount of need-based aid that you qualify for make the college affordable? So what do I mean by that? Well, I want to show you an example of a generous full need college. At this college, the cost of attendance is $72,000 and the EFC is $30,000. That means that there's $42,000 of financial need. And this is a generous college that meets full need. However, here's how they do it. The first $4,500 of need, they're going to meet with a loan. The next $2,200 of need, they meet with work study. They subtract the amount of loan and work study from the total need to come up with the amount of gift aid that's going to be awarded. So that, in this case, is about $35,000. So this family had a $30,000 EFC, but their net price, their true cost for the first year of college is about $37,000. That's another example of how EFC is not equal to the price that you pay for college, even at generous colleges. Now, in years 2, 3, and 4, this college actually adjusts slightly higher the amount of loan that it awards. So at the end of 4 full years of college, there's a total of $168,000 of need, and this college has met that full need, or $168,000. However, they've only met $135,000 of that with gift aid. So what that means is that the family with a 4-year EFC of $120,000 is actually paying about $153,000 for this college's 4-year degree. Remember, this is a generous college and it doesn't include inflation. So the takeaway from this is if your EFC times 4 plus about $40,000 is not going to be affordable for you, then need-based aid may not be the answer to your paying for college problem. If your EFC is $50,000, you calculate that on that EFC calculator, then you'd probably need to plan on having about $240,000 to pay for 4 years of college. So if need-based aid won't make college affordable, maybe merit aid will. So let's turn our attention to merit aid. And to understand merit aid, you need to understand a little bit about the business of college. Now, when most people think about college, they tend to think about college's acceptance rates. So at Harvard, 5% of the students who apply to Harvard are offered admission there. At Northeastern and BU, about 20% of the students who apply are offered admission. And at some other good colleges, but less selective, 60 to 70% of the students who apply are offered admission. Well, colleges, of course, do pay attention to the acceptance rate, but they also pay attention to another number, which is the yield rate. The yield rate is the percent of students who were offered admission to that college who end up enrolling at the college in the fall. So at Harvard, about 7 out of 10 students who were admitted to Harvard end up going there. At BU and Northeastern, about 1 in 4. And at Muhlenberg, Ohio Wesleyan, and Susquehanna, it's in the 14 to 18% range. Well, it turns out that when that yield rate gets into the 20s and less, colleges really worry about having enough students paying tuition in order for the college to have enough revenue to pay its bills. So what do the colleges do? The colleges discount their price with financial aid in order to compete for yield. So this final column that I'm showing you is the percent of students who are attending that college who are receiving college-funded gift aid. It might be need-based aid or it might be merit aid, but it's free money that the college is paying out of its resources to students in the form of financial aid. You can see that at Harvard, 57% of students are receiving aid. All of it is need-based. 43% of the students are paying the full price at Harvard. At Muhlenberg, Ohio Wesleyan, and Susquehanna, 94 to 100% of students are receiving gift aid. Some of it is likely need-based aid, but a significant amount of it is merit-based aid. And so if need-based aid isn't going to be enough to make college affordable for you, finding colleges that award merit aid may be helpful. So we said that merit aid is typically called scholarships. The major factors that go into it are things like GPA, class rank, and test scores. These past few years, many colleges have been test optional. Some schools don't report class rank. Don't worry about that. Colleges still find ways to evaluate students and award merit-based scholarships. Now, merit aid has historically been more prevalent at private colleges, but more and more public colleges are awarding merit aid now too. The highest awards at colleges that use merit aid go to the strongest students relative to the college's other applicants. And what that means is that students may end up receiving their highest merit aid offers at colleges they might consider their safety schools. So a safety school for admission may also be a safety school for financial aid. And again, college aid policies vary, ranging from colleges that award no merit aid to colleges that award primarily on the basis of merit. If you have an ESC that you cannot afford, then it doesn't make sense to apply to colleges that award only need-based aid. You want to look for colleges that also use merit aid in their awarding. So I want to show you some examples of how colleges award merit aid. And it's very interesting to compare the thresholds for eligibility for the highest awards to the SAT scores that correspond to the 75th percentile. The 75th percentile is the SAT score that marks the upper quarter of students who apply to that college. So at Gettysburg, for example, 25% of the students score higher than 1410 on their combined SAT. And their highest merit award corresponds to students who get a 1450. At the University of Tampa and Eckerd, they have a lower 75th percentile and a lower threshold at which students qualify for their highest aid awards. And you can see that there's also a correspondence to the lower awards offered by these colleges. And these lower awards correspond pretty closely with the 25th percentile, the SAT score at which 25% of the students scored lower than that at a given college. Well, it turns out that you can make some generalizations based on those observations. And here is the generalization. If a college uses merit aid, the best chances for the largest awards are when you're above the college's 75th percentile. If colleges use merit aid, the awards may phase out when you get to about the college's 25th percentile. But at colleges that compete aggressively for students, they may end up offering merit aid to nearly everyone who they admit to their college. So there's a significant potential for finding academic scholarships as part of your student's college search. So which colleges award merit aid? Well, that number that I was zeroing in on is the percent of students who receive college-funded gift aid. And you can find this at a great website called College Navigator. It's got all kinds of statistics about colleges. And you can see that at Gettysburg College in Pennsylvania, about 89% of the students receive college-funded gift aid. At Washington College in Maryland, 99% of the students do. Well, here's a rule of thumb if you're thinking about merit aid. If that percent of students receiving college-funded gift aid is over 60 to 65%, it's pretty likely that that college uses merit aid. If it's over 80%, it's highly, highly likely that the college uses merit aid as is part of its aid awarding approach. So where might your student get merit aid? Well, here's an example for a student whose SAT is about 1150, and that's roughly equivalent to an ACT of 23. You can find statistics about colleges' average SAT scores. I'm using US News and World Report on this example. And you can see that at Shenandoah College in Virginia, their 75th percentile SAT score is 1123. So that student with an 1150 is above the 75th percentile and is likely to qualify for one of the larger awards at Shenandoah. And you can also look on this page and see that at Suffolk and Boston, UMass Dartmouth, the student is also above the 75th percentile. It turns out that the student doesn't necessarily need to be above the 75th percentile. If the student is close, the student might not get the highest merit award, but the student might get a significant one still. So at Pace in New York, or Leslie in Boston, or New Mexico State, that student is also going to probably be in line for some type of merit aid. So this is a way that you can identify colleges that might be candidates to give merit aid to your student. Another place you can look for merit aid information is called the Common Data Set. Now, this is a set of detailed reports that colleges typically fill out each year, and you can find them by Googling the college name and then the words Common Data Set. And when you do, what you want to do is to find items H2A, N, and 0, or N and O, I'm sorry. Those are the number of first-year students receiving non-need aid, in other words, merit aid, and the average non-need amount. So the example I'm showing you is Hofstra University in New York. At Hofstra, about 24% of the entering first-year class received some type of merit award, and the average amount was about $24,000. So this is really a great resource for finding information about merit aid. Here are some examples that I found using the common data set. I'm going to show you two sets. The top set are some private colleges, and then the bottom set are some public colleges. You can see at BU, about 4% of the students received merit aid. And what that means is that if you're looking for merit aid, BU is probably not going to be the greatest place to look, because not only do you have to get into BU, which is very selective these days, but you also have to be such a strong candidate that BU thinks that you might be going to Dartmouth or Cornell instead. If you're looking for merit aid, places like Macalester and Dickinson offer it to about 20% of their students, and places like Muhlenberg and Ohio Wesleyan offer merit aid to about 30% of their students. So you can see that those are going to be candidates for offering more merit aid amounts. A lot of people think about the University of California. And if you're thinking about going to the University of California from a state other than California, you better be prepared to pay the full price, because at Berkeley, only 5% of the students get merit aid, and the average merit award is about $6,500. And I can tell you also that the University of California is not very generous with need-based aid for out-of-state students. On the other hand, Arizona State awards a significant amount of merit aid. 32% of the students get it. 94% of all students receive college-funded gift aid at Arizona State. So that could be a candidate for a discount on the price. So here's a rule of thumb when you're looking for merit aid. If a college has a relatively high admit rate, relatively low yield rate, and a high percent of students receiving college-funded gift aid, and the applicant is strong relative to the other students applying to that college, that's going to be a great candidate for a student who might get a discount based on an academic scholarship. So I'm going to finish up this section on need and merit aid with a table that just shows you the awarding approaches used by a variety of different colleges. And I've grouped them into 4 categories. The elite and the near elite colleges are the ones that are the most famous, the ones you've heard of: Bowdoin, Colby, Stanford, Amherst. These colleges tend to have very strong need-based aid programs where they meet full need, and they meet almost all of it with gift aid. They, on the other hand, have very little or no merit aid. That represents a small portion of the total number of colleges out there. And about 2,000 of the 2,400 or so colleges might be categorized as mid-market or other. Those are colleges that probably are not going to be as likely to be generous with need-based aid, but will have a high likelihood of offering a fairly large or large merit scholarship. All right, so we've talked about need-based aid, we've talked about merit-based aid, we've talked about how to determine your student's profile, and we've talked about how colleges award aid. Let's talk now about how to find your true cost. Remember, your true cost is called the net price. That's the cost of attendance minus the gift aid. And the way to find it is to use what's called a net price calculator. A net price calculator is required by law. Every college is required to have one, and they're required to tell you the cost of attendance, an estimate of the gift aid, and your net price. Now, just because colleges are required to have a net price calculator, they are not required to have a good one. And here's how you can tell whether a net price calculator is good or not. If it is super easy to use, you can get through it in 30 seconds, it probably stinks because it's not collecting enough information to give you a reliable estimate. On the other hand, if it asks a lot of questions, if it feels like it takes a long time to go through, it's probably doing a good enough job of identifying the various variables to give you a more reliable estimate. And don't worry, as you use them more and more, you'll find it becomes progressively easier to use them. And so you'll find that you become kind of an expert. And always remember, cost of attendance minus gift aid equals the net price. Now, when you use a net price calculator, you're often going to be presented with an output that looks something like this. And if you're not a numbers-oriented person, this can be kind of intimidating. Don't worry, just remember the fundamentals. Net price is cost of attendance minus the gift aid. Cost of attendance is made up of tuition and fees, room and board, books and supplies, transportation and other miscellaneous expenses. You subtract from that the total amount of gift aid, and the result is your net price for 1 year at this college. So always keep those fundamentals in mind, and you should be able to use a net price calculator to get some reasonable estimates. When you do, what you want to do is to compare colleges' net prices side by side. And this is the part where I want to stop for a second. We've been talking about dollars and cents, and that's really my big focus. But I also want to remind you that it's important that the student have a good college experience and get the education that's going to allow them to proceed with what they want to do in life. So I'm not necessarily advocating for the cheapest college that you can find. What I am advocating for, though, is that you find a college that you are confident will be affordable, so that at the end of 4 years, both the parents and the students will be able to move on with the rest of their lives without being overburdened by debt. And that's what we're going to talk about in the final few minutes of the presentation. When you're using net price calculators, you're going to be able to compare the net price side by side. That gives you a good idea of the cost, and then you can think, okay, these are the affordable colleges. Which ones are going to be the most appropriate for my student? So this is an example of a student with an ESC of about 15,000, B grades, and 1,100 SAT. And you can see that at Roger Williams, the student's net price is about 40,000. At Shenandoah, it's 36,000. At Wheaton in Massachusetts, it's 25. Orono is 22. Bowdoin looks great at 15,000. That's equal to the EFC just about. And USM, living with parents and commuting, is about 9,000. Now, a couple of points I should make. Bowdoin looks like it's got a great net price, but unfortunately, a B- student is not going to get into Bowdoin in most cases. So that's probably not going to end up being an option. So you want to make sure that some of the other ones that the student is more likely to get into are appropriate for the student and affordable. The other point I want to make is I know that going to USM and living with your parents and commuting to school every day is not an apples to apples experience compared with going away to college and living in the dorm. But the reason that I put that down is to remind people that there is always an affordable path to college for everyone. And it may not be your dream to live at home with your parents and go to USM, but if that means the difference between taking on unmanageable debt or not, it's certainly a much better outcome for that student by the time he or she reaches age 22 to be able to move on with life without having excessive debt. All right, So let's talk now about paying the net price. Remember that the net price already includes gift aid from the college, and that scholarship aid from other sources is very rare. The net price is going to be paid from income that you earn over time. And what do I mean by that? It might be prior income, income that you earned in the past and saved. It might be current income, income that you earn during the college years and can use to pay for college expenses. Or it might be future income, income that you earn after college and use to repay loans that you took out during college to pay for it. Loans are always the most expensive way to pay for college. So if you can minimize loans, you will find that you're going to be better off. So let's think about whether the net price is affordable. This is going back to that award letter we looked at the beginning of the evening. And if you remember, the net price for 1 year of that college was just under $35,000. However, college, of course, is going to be for 4 years. So there are some important questions that we need to ask. One of them is, how much are costs going to increase? And another very important one is, will the financial aid be automatically renewable and on what terms? Now, usually scholarships, merit aid is renewable as long as your student receives a passing or a grade equal to a standard that the college sets. So they might require a 3.0 or a 3.2 in order to renew merit aid. Need-based aid is typically renewable if you file the FAFSA and the profile again, and your income and assets remain pretty comparable over time. If there is any doubt, any ambiguity about how your aid is renewable or whether it's renewable, be sure you find out from the college before your student makes a commitment. All right, for this example, we're going to assume that costs increase 2% per year. We're going to assume that the aid is renewable and constant for 4 years, and we're going to assume that the student has $2,000 in savings and the parents have $25,000. And let's see how we pay for college. Well, that $35,000 a year inflated at 2% turns out to be $145,000 net price for that 4-year degree. The first place we're going to look is the student. And the student can get that work-study award. In this case, it was $1,800 a year. And the student can get federal student loans. If you need to borrow for college, federal student loans are always the first place to look. But there's a limit, which is $5,500 max in the first year, $6,500 in the second, and $7,500 each in years 3 and 4. That's the maximum in federal student loans that a student can borrow for 4 years of college. We also said that the student has $2,000 in savings. We're going to use that next. Remember that student assets count a little bit more heavily in the financial aid formula. So if we can use those up first, perhaps there might be a little bit more eligibility for need-based aid in years 2, 3, and 4. And finally, the student can get a summer job each year before college. If the student gets a job that pays $10 an hour for 40 hours a week for 10 weeks in the summer, the student will earn $4,000, pay taxes, go to Old Orchard once or twice, but the student should still be able to save $2,000 each summer to pay for college. At this point, we've used up the student's resources. Now we've got to start looking at what the parent resources are available to pay for college. Well, these parents looked at their budget and they decided that they could pay $375 a month or $4,500 a year out of their ongoing income for college expenses. So that's a great start. In addition, this family has some savings, and if they use $19,000 of it, they fully pay for year one of college. In year two, they're going to use the remaining $6,000 in savings, but they're not going to be able to pay the full amount in year two. To fully pay for year two, they're going to have to borrow about $15,000. Year three, they need to borrow 21, and year four, they need to borrow 22,000. So we have fully paid for 4 years at this college using prior income, current income, and future income. In this example, the student debt is $27,000 and the parent debt is $58,000. Now notice that I'm calling that borrowing beyond federal student loans parent debt. There are a couple of reasons for it. For one thing, after the maximum amount of federal student loans is used up, no other lenders are going to lend to that student without having a cosigner. That's usually the parents. And the other reason I consider it a parent obligation is because I don't think any parent wants their student to take on excessive debt. And students really are not in a good position to evaluate how much debt they can afford. $27,000, I'm going to show you in a second, is often, I think, a reasonable number. But borrowing more than that for the student is going to get them in trouble very quickly. So I consider any borrowing beyond that federal student loan to be a parent responsibility. Let's talk about whether that amount of borrowing is reasonable. And to do that, we've got to figure out how much federal student loans or how much education loans are going to cost. It turns out that student loans carry about a 4.5% interest rate. Parent loans are about 7%, and you pay them back over 10 years, beginning 6 months after college. At those interest rates and at that term, it turns out that for every $1,000 of student debt, the student needs to pay $125 per year, per 1,000. For every 1,000 of parent debt, the parents need to pay $140 per year, per 1,000. So in this example, the student has $27,000 in debt. 27 times 125 is $3,363 that the student is going to have to pay back each year for 10 years to pay off those student loans. For the parents at $58,000, they've got to pay 58 times 140 or $8,100 per year for 10 years after college. So that tells us how much the loans are going to cost. It doesn't yet tell us whether that amount of debt is reasonable. I think a good rule of thumb is that payments for education debt should not exceed about 10% of gross income. And so for the student who borrows $27,000 and needs to pay back about $3,400 per year, that student needs to get a job that pays $34,000 a year in order to have 90% of his or her income to pay for rent, groceries, taxes, and everything else. Well, the good news is that a new college graduate on average makes $40,000 to $50,000 a year. So I think that borrowing that $27,000 is not a bad trade-off for the student to get the benefit of a college degree. For the parents, it's more complicated because they've got to consider their other obligations. They've got to think about college for their other children, and they've got to think about retirement. And in this example, I see a big red flag. Remember, when we were talking about the parents' budget, they said they could pay $375 per month or $4,500 per year for college. What makes these parents think that if they can only afford $4,500 a year during college, that after college, they can all of a sudden pay $8,100 a year? This does not look like an affordable scenario for this family. So this is a good way, I think, to evaluate all of the colleges that your student is thinking about. And what I recommend doing is defining your zone of affordability. Your zone of affordability represents the highest affordable price, And if you identify that highest affordable price, then all of the colleges whose 4-year cost of a degree will be less than that will be affordable for you. I use as a default identifying the parent debt-free point as how I define the zone of affordability. So I think that if that student can take on the $27,000 and the parents can take on 0 debt, that's probably a good place to start in thinking about what's an affordable college for your family. When you're thinking about your zone of affordability, it's helpful to make up a table with 2 columns and 3 rows. The columns are going to be for the parents and the students, and the rows are going to be prior income, that's savings, current income, money that you or the student can pay during the college years, and future income, money that you earn after college to repay debt. And when the parents are thinking about it, I would think about that no parent debt point. So students can automatically come up with about $43,000 to pay for college using current income, work study, and summer savings, plus the $27,000 in federal student loans. And filling in those remaining boxes, student and parent savings and the amount that parents can pay from income will help you identify your zone of affordability. A lot of people talk about college a lot. I know it. And people say, how does everyone else do it? The way they do it is exactly the same way I'm describing to you tonight. People find colleges. They can figure out colleges that might award gift aid, grants, or scholarships. When you subtract the gift aid from the cost of attendance, that's the net price. You can also think about the resources that you have to pay for college. All students automatically have $43,000. If the parents have some savings and money they can budget from income, that adds to the amount of resources that are available to pay for college. If the resources don't equal the net price, there is a gap. And that gap can only be filled by taking on more debt or finding a lower net price. This is how everyone else pays for college. It's those 6 sources of college resources. And remember, taking on parent debt is very dangerous. So we talked about a lot of heavy stuff. I think it's helpful to put it in perspective. And one way to do that is to think about it as part of the stages of grief. A lot of times you may have dreams of certain colleges, and if they're not going to be affordable, maybe it's best to kind of put those behind you. Another thing to keep in mind is that college is important, but it's not the goal. The goal is to set the student up for a successful life after college, where both the students and the parents will be able to go on with their lives without being burdened by unnecessary debt. And if you think about how you've gotten jobs or the types of things people ask about when they're hiring, it's very rare that people ask, where did you go to college? What companies want to know is what you're going to do for them, what you've done for your work in the past. It's very rare that going to an expensive college pays off in dollars and cents. Here are some examples of some very successful people who did not go to brand name colleges. The guy who started Starbucks went to Northern Michigan University. The guy who was the longtime CEO of Walt Disney went to Ithaca College. And the woman who's the CEO of Hershey Foods went to Shippensburg College in Pennsylvania. That's kind of a Pennsylvania equivalent of USM. Another thing to keep in mind is that it doesn't necessarily pay to pay a higher price for college. So the difference in the amount per year that people make mid-career for if they graduated from Colorado College, Connecticut College, or Allegheny College is $1,200 per year, but the difference in the 4-year average net price is over $100,000. So that's a big difference in the cost of college compared to the benefit in terms of dollars and cents. So how can you find financial safeties? There are two big methods that I think can work. One of them is to use the methods that we've talked about tonight, using the percentages of admit rates, yield rates, the percent of students receiving college-funded gift aid to identify affordable colleges. Another way is to seed your list. And by that, I mean to put colleges with different approaches to the way they award aid on the student's list. So for Maine students, a University of Maine college is almost always going to be affordable. Sometimes an out-of-state public college or a secondary out-of-state public college like Keene State might be affordable. If the student has high need, then a highly selective private college might be a good choice. If you don't think need-based aid is going to be the answer and want to identify colleges that award on the basis of merit, the group called the Colleges That Change Lives often have pretty good merit aid awards. So these are a couple of ways that you can identify financial safeties for your students' list. The final thing I want to leave you with is a tip. If you contribute at least $1,000 per year to a 529 plan run by the state of Maine, every Maine student can receive $300 a year in free money. So even if your student is in high school and only a few years away from college, this is a way for you to get maybe $1,200 or $1,500 in free money to help pay for college. It's probably not going to pay for the bulk of it, but everything helps. So with that, we're just about done with the formal part of the presentation. I want to let you know I've got a website and I've got some links to some resources that you might find helpful. I also want to encourage you to get in touch with me if you'd like to get a copy of the slides. I'll be happy to send them to you. And so with that, I'm going to end the formal part of the presentation